Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is January 24th edition of Market Outlook. Well, quite interesting markets. We have oil rebounding sharply and that having a tremendous impact on equity prices and the relationship between oil and the equities market pretty pretty well established here. And interesting to note that number one, oil reached levels where it was back in 1990, right around the start of the Gulf War. So, considering inflation, that's quite a drop down. It's equivalent to almost a 75% drop in the price of oil from the highs in the early part of this decade. So, first of all, just from a longer term perspective, it's good to step back, especially when markets are doing the type of volatile dance they are and where certain assets are at extremes. So, one thing to really note is that the composite index, the NASDAQ 100, back in 2000 peaked at just over 5,000. Now, we have not been able to close on a monthly basis over that peak back in 2000. So this whole sideways action could be seen as compression. That compression really started back in 2014. So if you look at it, I mean, you can see that we've moved around quite a bit, but really have made no headway since the beginning part of 2000 or the mid part of 2014. So where we closed was where we were at 2014. So that's a good amount of compression. Just a year and a half already of sideways action. So it can be construed that a break of those important lows that were set this week and going back over the last year or so are very, very critical. And two ways to look at that. If we break the compression to the downside, most likely we're going to get a test of our longer term moving average, which is the 80-month moving average, going back to about 3,400 or 3,378. And again, this is a rough, within a couple of percent type of range where the market could retrace to. Now that's a pretty good size correction. On the other hand, it could be construed that this sideways compression that started in the beginning or the mid part of 2014 is compression. And if we get an upside breakout over the compression, which is around the 52 or 5,300, let's get that exact here. Yeah, just above 5,200. So a closing price above that 5,250 or so would mean that we have broken out above the this double top that seems to be forming. On the other hand, again, just want to reiterate that a downside breakout would be quite ominous as well. But that is the way to view this action in the context of the bigger, longer term charts on a monthly basis. With that said, let's try to drill down into what's happening on a shorter term basis on the S&P as well. So we're going to do our normal fare here. First of all, looking at the daily charts on the S&P, you can see we basically tested what I would call or created a potential triple bottom. The key thing here to remember is the more times you get a test of a particular low or particular high, the less likely the next time it is to hold. So at this point, with 3 tests here, another test of that low would be fairly critical. And it even goes back, again, it's very similar to the S&P, the NASDAQ chart, back to the lows in 2014. So we take that out, it's 1, 2, 3, 4 lows taken out. Now, with that said, let's take a look at some of the volume patterns here. Interestingly enough, that we had that 500-point down move where we basically still closed down, but closed in the upper part of the range that looked like a blow-off low, which is possible. But there are a couple caveats here with that action. Number one is the volume. Usually, in order to see a real capitulation low, I like to see blow-off volume. We did not get that. You see in here, here's our volume. The volume was actually heavier just a couple days prior, and that certainly led to further downside action. Now, if we go back to August of last year, you can see massive volume and huge range on that blow-off day, a complete washout. That did not occur. So with that said, even though the action looks pretty decent here, and there are some good market internals that we're going to get to, the actual price action confirmed by volume, even though the volume was high, much higher than normal. We hit, almost, let's see here, 300 plus million shares, not quite double, or just almost double, but not quite there. We definitely like to see double or triple the volume on one of those blowout, washout days where you do get a sustained reversal like we did back in August of 2015. So that is suspect. Now, additionally, what we have in the S&P are more distribution days. In fact, we don't have on the daily chart over the last 2 weeks, we've got one accumulation day and we have 3 major distribution days. So and of course that blow off volume, which would negate the amount of distribution days, has not occurred. So we have very iffy volume patterns. Let's take a look at the market internals. Interestingly enough, we've certainly hit on market internals, oversold conditions where we've bounced. Now, McClellan oscillator sitting right at a -12. If we can get started above the 0 line, that would really confirm the oversold readings and a more bullish situation. But overall, all 3 of these indicators hit oversold. That's the shorter term up-down volume and advanced decline. So we definitely have gone into a situation where we got deeply oversold and are bouncing. This is consistent with tradable market bottom. So evidence here, we'd like to see further continuation with the McClellan. That would give you, if we get above the 0 line, a further confirmation that sort of a potential further rally is in order. Let's take a look at some of the sentiment indicators as well. Okay, taking a look at the ratio between short-term and longer-term volatility, that's 1 versus 3 months. Focus on this center chart here. Obviously, the demarcation here of the first blue line is first levels of fairly overbought versus very overbought. Conversely, down here, the blue line here at a 1-to-1 ratio is starting to look a little bit too negative on sentiment. Extreme sentiment to the negative side, it starts at 0.9. Now, obviously, like every indicator, oversold or extremely negative sentiment can get even more so. That's sort of what happens. So in essence, these 3 lines, one line here, the red line, is the actual ratio. And as you can see, it just hovered and finally confirmed nicely above the first level of extreme negative sentiment and turned positive. So what I like to see is the other derivative lines, which are moving averages of the ratio, get oversold in conjunction and all turn up, which they have. So we've got plenty of more room of momentum to the upside, which would work off the oversold condition. So certainly from market internals to market sentiment, we have oversold conditions leading to this bounce, which has a lot more to potentially run to the upside. Looking at the VIX independently by itself as a confirming or non-confirming indicator, we did get above the upper end of the Bollinger Band and now are moving down through it, which meant that the absolute reading of looking at the VIX also a little bit too much frothiness or extreme pessimism is now working itself off. That's usually a bullish indicator as well. Now, with that said, we are trading above the 50 and 200-day moving average, which means that the longer-term trend, even though it has room to correct in terms of sentiment, is in a bearish mode. Now, obviously, it's been hovering really around that 200-day moving average. It could come back and equate to a move back up in the S&P. Let's take a look at that again, where this might potentially bounce to. So if the market internals can overcome what is definitely a headwind, even with the rally in oil, as oil is not clear that it is really fully played out and that the bear move over, although it was a nice tradable, or it's starting to look like a tradable bounce. Potential rally back up in the S&P looks like around the 200 level, also with the 50-day moving average. Obviously this year moving into the market's moving into a bear phase should act as resistance, and that's somewhere around the 200 level, maybe up to 202. But again, massive resistance right around that 200 level. So you're talking about a good, potential 4 to 5% move to the upside if things do materialize. But again, what we're talking about here is fairly mixed. We don't have the volume confirmation. We do have the trading pattern that looks like a complete washout of the double bottom, or now what would be called a triple bottom, which could be a tradable, 4 or 5% bounce from here. And then we have to take another look. Let's take a look at calendar range, because that's confirming as well. On the S&P, we now have the 6-month calendar range. Interestingly enough, if we see how this plays out, even though we tested the range earlier the week on the 500-point down move, the 6-month calendar range low that was set in the first 2 weeks of January held on that day. Any close below that calendar range would be suspect. In addition, the high of the calendar range, which is both the 1-month and the 6-month calendar range, finds resistance at that 198 to 201 level, depending on which one you're using, right? The 6-month comes in around that 201 level, 202, and the 1-month calendar range starts around the 198 level as well. So this blue line should act as resistance. Let's get an exact, precise number on this one here. Yeah, so that's just above 198, about 198.50 is the 1-month calendar range, just the January one, not the 6-month. 6-month comes in a little bit above. But nonetheless, you're talking somewhere between a 4 or 5% rise before some real resistance should kick in. One last thing, let's cover gold. And one thing that's interesting here is, as you can see here, gold seems to be basing out. We have moved into a recovery phase. So what's interesting is that 50-day moving average starting to turn up. We're holding that 10-day. It would be interesting to see how gold reacts. If, in fact, we do get that rally, I wouldn't be surprised, of course, to see it sort of test the lower parts here of this sideways trading range. But nonetheless, gold did act relatively well on Friday on a relative basis. Notice with the S&P up over 2% on Friday alone, gold down 0.56%. On a relative basis, gold seems to be losing its steam to the downside and actually consolidating and starting to move up. If we can hold those levels from the last 2 weeks, we should be in pretty good shape on at least on an intermediate term basis. Next level of resistance comes in around the 200-day moving average, where we penetrated it a couple of months ago and was not able to hold. Again, this washout low and this sideways compression action definitely looking more interesting for the yellow metal. All right, well, that's it for now. See you next week. We've got some interesting reports on some key stocks like Apple next week. That will definitely have an important effect on the market. Another last final thing to remember is on a more positive note is that the cash levels of fund holders and the outflows of money from equity ETFs and mutual funds are at record levels. So usually when cash levels are extremely high, and we're talking about some of the highest levels over the last 30 years, people have definitely gone to the sidelines, gone to cash. That's usually a good contrary indicator. So adding a bit more positive note to the overall picture is that that cash levels are showing extreme bearish sentiment, which acts in reverse. Thanks, bye for now, and see you next week.